Hey, good morning, guys. It is Wednesday, May 27th, and I've got some updates that I want to share with you on the PPP, that Paycheck Protection Program. I've been kind of sifting through here the 40 pages of updates that came out in two interim final rules that were released late in the day on Friday. And there's a handful of key items in here that I think are worth mentioning and that are certainly going to play into this process or be good knowledge for you to have as you work through the forgiveness process. So let me run through them here and give you a quick idea. The first one, the interim final rule, deals with the forgiveness process itself. And a couple of key things to note. One, it actually states in here, and this is something we've been looking for, is how is the interest going to be handled on the forgiveness, because it's been kind of silent. It keeps saying that there's forgiveness on the loan amount, but not the interest amount. And it states now in item 2 in this one that the SBA will remit forgiveness plus accrued interest to the bank through the date of the payment. So that looks like the interest for the forgiveness amount is being paid by the SBA to the bank. So I would think and hope that the banks are not going to be looking for you as the borrower to pay interest on that money up to the forgiveness amount. Obviously, if there's anything that's not forgiven that goes forward, there'll be interest on that because it converts to a loan. Another interesting point, item 3B in this document, payments to furloughed employees and bonuses or hazard pay are eligible for forgiveness. There's been questions. A lot of folks have said, can I bonus my employees? Can I do some things here to make up, some of the pay that they didn't have? The answer is yes. And I'm going to talk a little bit more about this on another point here in a minute. But yes, you can count bonuses, furlough pay, hazard pay. They are all eligible for forgiveness. However, keep in mind you've got that cap of $100,000 annualized over the 8-week period. The next one here is a very interesting piece that was added. There was an earlier reference in the frequently asked question document that talked about what happens if an employee is offered to return and they choose not to return. Do you have to count them towards your full-time equivalent? And the answer is no, you don't have to count them. But there was a further clarification in this release of the interim final rule that added a step to the process, that if you offer a position to somebody to come back and they refuse to return, you as the employer now must notify the state unemployment department. So basically, you're required to tell the state that they were offered a position, they chose not to come back, and because of that, then they're not going to be eligible for unemployment any longer. So that may factor into some employees' decisions of coming back or not, to know that by law now here you are required to inform the state. The next one here, item 5E, has to do with reductions based on the salary reduction. There's been a lot of confusion around this. When you look at the forgiveness application, there's these calculations you have to make. You've got to compare January through March payroll or compensation to the 8-week period, and then calculate from that the amount of reduction if the compensation has gone down. But the really interesting thing in this section now in 5E, not only did they explain it a little bit further, but actually provided a detailed example. And the thing that was very comforting to me in that example is that the reduction is only going to be based on salary. I've gotten many questions about, well, this doesn't make sense. If I've got a sales rep that made a bunch of commission in Q1 because we were open and selling, but during this 8-week period, we've been restricted as to what we can do. The sales aren't as much. How do we make that work? Well, the example that was given and the way that this has been interpreted and the way I'm interpreting it now is it's salary only. So if you had somebody that was on salary as a salesperson, you're looking at their salary during the 8-week period as it compared to their salary back in January through March. If it was reduced by more than 25%, you have to reduce your loan forgiveness amount by the amount that it falls, that's more than that 25%. So it gets a little complicated, but it's changed the calculation considerably from what I had originally interpreted it to be, to bring that down considerably. And then there's another piece here I'll talk in a second when we get down a little further into 5G, but it's a pretty easy way to be able to wipe out that reduction entirely just by reinstating the salary where it was. But before I get to that, the next one here, point 5E, this is another one. There have been some questions. How do I handle if there's a reduction based on the full-time equivalent employee count? Because you have to have the same number of employees during the 8-week period as you had in one of two different lookbacks. You have at your option either January, February 2020 or February 15 to June 30, 2019. You can pick which of those two reference periods you want. Then you compare your head count during the 8 weeks to that, and if it's down, you have a reduction. However, you would not have to take both a wage or a salary reduction and a full-time equivalent headcount reduction. Let's say you cut somebody's hours by 50%. Technically, they're no longer at that point a full-time equivalent. They become a 50%, and their wages went down. You do not have to actually take the hit twice. That would be a double charge on that or a double penalty. So the calculation allows you to drop out the salary portion if you've got the full-time equivalent headcount portion. Again, very confusing with all these calculations. We've been running through models and models with lots and lots of folks here, and kind of learning as we go and as we're getting more data clarified. But yes, so you don't have to get basically a double hit. Now the next one, and I think this is one that's going to be very helpful, and we've talked about it in many different occasions here, and that is this, safe harbor date of June 30th. That if you restore your full-time equivalent headcount, or, and these are treated kind of separately, your wages to the levels that they were in the previous measurement period. So for wages, again, that's January through March 2019. If the salary is back to the level that it was back then by June 30th, there is no reduction. And the same thing with the full-time equivalent headcount. If you get the headcount back to where it was prior to your one of the two reference periods, either again that February 15 to June 30, 2019, or January, February 2020. If you get the people back on board and you restore that headcount, then there is no reduction. So I really do think as things start to open up and we start to look, 30 days down the road here, we're closing in on the end of May. Then we've got till the end of June to look at restoring salary levels and headcount levels. I think it's a pretty doable target for most of us out there. And if not, then we'll look at calculate what the forgiveness amount that would be lost. And it still may make sense to drop your forgiveness somewhat to have your headcount be where you really want it to be come June 30. So a couple of big changes in that one, or at least maybe not changes, but clarifications and additional data. The other document that was released also on Friday, end of the day Friday, was an interim final rule on the review procedures. And this has to do with how these documents or how the PPP plan and the forgiveness is going to be reviewed. And a couple of key points to take away from this one. First one in item 1, they make it very clear that the SBA may review any loan they deem appropriate. Doesn't matter what size. If the SBA decides they want to review a loan, they have the ability to review a loan. Later in the document, it gets into the process. If they decide they're going to review a loan, they have to notify the bank. The bank will then have 5 days to notify you as the borrower. And at that point, the forgiveness process kind of goes on hold while they're doing that review. Now, remember, in earlier direction, we were told that every PPP loan above $2 million will be reviewed. So if you've got one of those larger loans, it's going to be reviewed by the SBA. We know that already. Further in this item 1, it talks about the SBA may review. What they're going to look at is if the loan amount was correct. Now, I know we've had some folks that know that the bank did not correctly calculate this. So one of the things they may do is look at it, see is the loan amount correct or is it not. I would suggest if you feel that the loan amount was inaccurate, especially if it was inaccurate high, then I would be careful with that, because if it happens to be reviewed, the SBA could come back and say, wait a minute, your loan amount was too much. And if your loan amount was X and it should have been Y as a lower amount, and you got a forgiveness above what the loan should have been, there's a chance that they could say you weren't eligible for that and you owe it back. So understand, again, I think, for anybody who's got a loan that's less than $2 million, the chances are pretty slim that it'll be reviewed, but the chance is there. We have to understand that. And then they can also review it to determine if you're entitled to the forgiveness. Another point in here that's just I guess a good one to keep in the back of your mind is it reiterated the need that you as the borrower must maintain your records for 6 years. So once the forgiveness is done and granted, you make sure you've got everything. I would have it all scanned, put away someplace, saved on a network drive and backed up somewhere, so that if in the future at some point there's a question on it, you've got that documentation ready to go. All right, the next one that I thought was very interesting, at least to have in the back of our minds as the borrowers, is item 2, deals with what the lender's responsibilities are in this review process. And it actually states what the lender should review is receipt of the certifications, meaning that document, that forgiveness document, you're certifying certain things. So the lender has to review to make sure that they received your certifications, that they received your documentation, and it states that they should confirm the calculations. And it goes on to say, and I'll give you this quote right from the document, lenders are expected to perform a good faith review in a reasonable time of the borrower's calculation and supporting documents. So the banks are going to be basically here required to do a good faith review to make sure that you've submitted everything, that it looks like the calculations are correct. There's some detail that goes in an example. It says, if the borrower is using a well-known third-party payroll company, that they don't have to go and check all those calculations. They could assume them to be correct. However, if no payroll data is really being provided, then the lender probably needs to take a deeper dive. It also goes on, I think this is an interesting one to note too, is if lender identifies errors, then the lender has to work with the borrower to remedy it. So if they do identify an error for some reason, they need to come back to you and say, we found this error, we got to figure out, let's get it corrected. And their job now is to help fix it, not to just turn it down. And then it goes on, it says specifically again here, and this has been stated earlier, but that the lender does not need to independently verify reported information. So they're not auditing this. They don't have to go and verify and say, wait, give me this record, give me that record. They have to check your calculations to see what you provided, the numbers match and they add up and that everything looks to be correct. And then another one that's kind of interesting, and I think just to understand the mindset of the banks and what they're going to be dealing with, I've made a number of comments on this point that I think the bank's interests are pretty well aligned with our interests in wanting to maximize the forgiveness. Because remember, keep in mind, whatever amount is forgiven, the SBA is going to be remitting to the bank plus the interest that accrued over that period of time. So I think the banks are going to want to see the maximum forgiveness that can be calculated, because they're going to get that money back right away. They're going to have their ability to go and loan that money out to other folks at a much higher rate than the 1% it would convert to if it's not forgiven and it goes to a loan and you as the borrower decide to keep it. Right? These banks don't want a bunch of 1% interest loans on their books for 2 years. They'd rather, I think, get their forgiveness monies back, have that cash, be able to lend it out at a much higher rate than 1% and longer terms than 2 years. But it's kind of interesting here too, is that if a loan is found to be ineligible, the lenders are subject to a clawback of their fees. Now remember, the lenders are being paid a fee to process these loans, and the majority of them fall into the two lower brackets, which are 5% or 3%, and actually the vast majority in quantity of loans fall into the category of a 5% fee being paid to the bank. So again, I think the banks are going to be on our side here and want to work with you to get this done. I do think there's going to be a tremendous amount of work that they have to do. I think there's going to be more work required by the banks in the forgiveness process than the application process. The law and the statute gives them 60 days to perform their review and give you an answer. I would say we want to make sure we have a good, clean fully documented package ready to go. Get that to them as soon as possible, and hopefully make it easy for them to do their required review, and then be able to approve this very quickly. Get it from their books over to the SBA. Get the SBA to then fund them. Then we know that okay, we've cleared that hurdle. The only thing that could come back, and again, I think very, very slim chance, is if the SBA at some future date decides to review it. So again, I wanted to get this together and get it out. I'm going to get it to you guys pretty quickly here this morning. If you have questions, by all means, shoot me an email or call me, and we can go over it. Everybody, most importantly, again, stay well, stay healthy. I know here in New York, we're just starting our, quote, reopening into phase 1. I know different parts of the country are in different stages, but you can start to see, some kind of hope and optimism for moving forward here in the future, and business starting to work its way back to in gear, and to this new normal everybody keeps referring to, that I guess we'll figure out what it is when we get there. But be well, obviously be productive, go out there, drive your business, and again, if you have questions, let me know. Look forward to speaking with you soon.